All right. Today is Wednesday, the 10th of August. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. We got the CPI out of the way, and the reaction by the stock market was euphoric. Massive orgasm, assuming that this is peak inflation, the Fed is not going to tighten anymore, and higher we go. More juice to the rally. But does the CPI really support what's going on in the stock market right now, or does the CPI actually suggests that the stock market is getting ahead of itself with the assumptions? This is exactly what we're going to explore in this video using the facts and the data. And without further ado, here it is in focus tonight. The devil is always in the details. You know, all what I heard today is peak inflation. The Fed will have to actually ease from this point on. The market was right. Higher we go. The soft landing is here. The sky is clear. Yada, yada, yada. Of course, these folks are giving material for the next intro in the Maverick Wall Street channel when the market turns down, not if. But let's not get ahead of ourselves here, folks. The headline reads, inflation moderates in July as the CPI rises at a less than expected 8.5%. 8.5% inflation. Wow, that's really good, right? And here's the details. These are the categories of the CPI. Highlighted in green means that went up month over month. Highlighted in red, that means this category went down month over month. I look at it month over month because if we're going to talk about a soft landing or the Fed pivoting or the recession out of the picture, any of these assumptions, it depends whether the month-over-month CPI is rolling over or not, specifically in the core CPI. So let's take a look. When it comes to food, month-over-month, prices went higher by 1.1%. So that's peak inflation, right? Matter of fact, prices at the grocery store in July had the largest price increase since 1979, with one food staple rising higher by 38% on the year. And that food staple is eggs. 38% price inflation in eggs year over year. But wait, there's more. The inflation for food at home went higher month over month by 1.3%, and food away from home was up by 0.7%. The prices of electricity were up month over month by 1.6%. Likewise, in the core category, new cars were up by 0.6% month over month, and medical care commodities were up by 0.6% month over month, and then shelter was up by 0.5% month over month. That's a joke, of course. We all know that rents are out of control. Shelter inflation is way above half a percentage point month over month, and it is certainly way above the 5.7% that the CPI gives us for shelter inflation year over year. In certain cities, rent inflation is above 30%. But anyhow, the cost of medical care services, that went higher by 0.4% month over month. So all of these categories, the inflation continues to move higher month over month. No peak inflation, and certainly nothing is rolling over at all. But here are the categories that went down in price month over month, and they're mostly energy commodities, whether we're talking about energy, gasoline, fuel oil, all went down significantly month over month due to the decline in commodities. Now in the core category, used cars went down month over month by about 0.4%, and apparel went down by 0.1%, and transportation services went down by 0.5% month over month. So here's the take, folks. Absent of the decline in energy commodities, the reading would have been really horrific. We would have gotten 9.5% plus CPI, if not double digits. Now, is the decline in gasoline prices and energy commodities really sustainable? Because in the assumption of saying that the CPI inflation is peaking, you gotta assume that energy commodities are peaking, and the tailwinds pushing energy commodities higher are gone now. Well, here are the facts. The headline reads, gasoline supplies in New York Harbor are the lowest in a decade, making the region more prone to shortages. And look at this. Supplies nowhere to be found. This is the lowest amount of inventory since 2012, meaning the demand could spike up higher again, and we could see gasoline futures moving higher again. They don't have to go back to all-time highs, but they just have to move a little higher. And the entire theory behind peak inflation and the Fed pivoting go out of the window completely. And all in all, when we look at the CPI inflation year over year, the reading went higher by 8.5%, month over month flat at 0, while the core CPI, all eyes of course on the core CPI. You would think from the market reaction today that the core CPI actually went down. It did not. Matter of fact, year over year, core inflation went higher by 5.9%, a month over month. It was actually higher by 0.3%. We will look at the sticky price CPI, for example. That actually went higher in July, and this is according to the Atlanta Fed. Likewise, shelter prices continue to skyrocket with no stop in sight at all. And when we talk about the Fed pivoting, you gotta understand that they have to get inflation down to 2%. We're now at 8.5%. Even the core is above 5%. So a lot of work has to be done. They're not through with the job yet, but the market is assuming that they're done. From this point on, they're going to do maybe 50 basis points now in September, maybe 25, and then they're done. The market is actually pricing in interest rate cuts. Now, did the Fed come out today and say, okay, according to this CPI, the soft landing is here, we're done with the job, folks, please get back in the casino and go all in? We're done. We're not going to tighten anymore. We're not going to stand on your way. On the contrary, today we got Fed zombies, this time around from Chicago, Evans, who's supposed to be dovish, who's supposed to come out and say, this CPI reading proves that inflation is peaking and we're done here. But instead, Evans came out and said that the July CPI data was positive, quote unquote, but nobody can be happy with 8.5% annual inflation rate. Perhaps this is the biggest surprise. Another Fed zombie, the demon from Minneapolis, Neel Kashkari, the king of the doves. Forget about Williams. Neel Kashkari is the true dove. And now Neel all of a sudden is becoming the king of the hawks. Minneapolis Fed President Neel Kashkari, who in June revealed he had projected the need to take the Fed funds rate to 3.9% this year and 4.4% next year, tells whoever that is, recent inflation and employment data have not changed this forecast. On top of that, Neel Kashkari said that the idea of rate cutting early next year is not realistic, quote unquote. And of course, this is the same guy who last year said he opposes interest rate hikes all the way till 2023. Now all of a sudden he's the king of the hawks. And Mr. Kashkari, if you're listening to this, you wonder why the public has no faith or trust at all in the Fed. You wonder why the market has absolutely no trust in the Fed, and the market is now assuming that the Fed is bluffing and they're actually going to cut rates, not increase them higher. You wonder why? Because of all of this flip-flopping. And last year, you guys been saying transitory, not thinking about increasing interest rates. Of course, the market is having the comfort that you guys are bluffing, and folks are going all in right now, throwing cash into the stock market, not knowing that the guillotine is about to drop. And here's a good take from Sven Henrik, who says, Fed speaker after Fed speaker insisting on a coming 4% effective Fed funds rate. Markets are trading like rate cuts are already in the bag. Someone is lying. Either the Fed or the S&P 500. Now, let me know in the comments, who do you think is lying here, the Fed or the market? Because there is a rule that says don't fight the Fed. Fighting the Fed will always cost you money. You're always going to end up holding the bag fighting the Fed. So why is the market fighting the Fed right now and saying, Fed, you're lying, you're bluffing, you're not going to do it? We talked about the trust issues, of course. But has the market become completely deaf to the tune of the Fed? Are we seeing euphoria and arrogance washing the stock market again? Or is the Fed indeed bluffing? Are they just lying and playing psychology? Why would they lie at this point? They've already embarrassed themselves with the transitory call. If they keep coming out and saying, we're going to raise rates, we're going to raise rates, we're going to raise rates, and even the most dovish Fed presidents come out and say, we're not done here. We're not even close of being done. It's not even realistic to assume that the Fed will cut interest rates. You think Neel Kashkari is saying this because this is what he actually believes in? Think again. If it's up to Neel will cut rates right now. But these are orders. These are top to bottom orders. Come out hawkish. They're not believing us. And therefore we're seeing Williams, Evans, Kashkari, Daly, all of the doves are coming out hawkish, telling us over and over again, they're not bluffing. They're going to increase interest rates higher. So who do we believe here? We have to trust the data. And we have to trust the mature reaction, not the euphoric, the FOMO kind of reactions. The data in the CPI says, just look at food inflation, look at shelter inflation. This is going to be a major problem. They're not even close of being done. All what we need right now is something to flare up again in the Ukraine front, and energy futures will blast higher again. And then what happens? What component of the core CPI that supports a peak theory or a pivot theory? The answer is none. You think it's going to be used cars, airplane tickets, That's not going to be it. You think rent inflation will go down anytime soon when it is a lagging indicator in the CPI? So the data that we got today from the CPI says the market is the one that is lying. The market that is the one that is creating a trap, luring more and more and more cash from the sidelines to chase the rally. In other words, FOMO. And FOMO usually the last run of any rally. Folks see certain stocks that doubled in price in about 3 weeks or so. They see the market blasting higher today. They see even the meme stocks moving higher. And they feel all clear. We're done here. Let's go all in before we miss out. We're missing out on the rally. And that's how the trap is done. And you can hear it from the sentiment, not just from the bulls who become euphoric and arrogant, but also from the bears. The bears start to capitulate. The bears start to say, you know what? I think the bottom is here. I don't think the market is going to go down. The market is crazy. It doesn't make sense, whatever. And they start to capitulate. That's when you know it's over. And perhaps this is the most important reaction that I got from the market today. Not from the stock market, but from the bonds market. This is a chart of the 10-year yield. As you can see, initially, when the CPI came out, the 10-year yield went down big. And it lost about 5% of its value. But then it rebounded higher and recouped all of the losses and closed at the highs of the day. As if the bond market says, I believe the Fed, while the stock market says, I don't believe the Fed. And folks, I've been doing this for a long time. As a trader, I've been trading since I was 18 years old. But I've been doing videos on YouTube for over 2 years now. That gave me a lot of experience on the sentiment of the stock market. What we're seeing right now is no different than the rally in August of 2020. The split mania. The technicals don't matter. The fundamentals don't matter. Nothing matter. Higher we go. We're all missing out. It's FOMO. And we all know that that was the top for a long, long time, specifically in individual stocks. The sentiment right now is reminiscent of the Santa rally of 2021, when everybody said, it doesn't matter what you say about the Fed tightening the policy. It doesn't matter what the technicals say. It doesn't matter what the valuations say. Higher we go. I have the FOMO. I'm afraid of missing out. We all know what happened next. In my opinion, this is the same sentiment all over again. Bottoms happen in two ways. The most reliable bottoms happen via a process of consolidation, being boring for a long time. And slowly but surely, we see the market moving its way higher, gradually. And this was the case back in the bear markets of the early 2000s and the early 1980s. Another form of a bottom happens with a spike, an instant spike higher that marks the bottom, and the market doesn't look back from this point on. These kind of bottoms always happen by the Federal Reserve when the Fed starts easing the monetary policy. Case in point 2009, case in point 2018, case in point 2020. All of these crashes, the bottom happened in a spike, a massive spike higher the moment we knew the Fed is about to ease the monetary policy. This bottom that we have right now, the June bottom, is eerily similar to the second kind of bottoms, not the gradual process of bottoming, but the spike higher. Yet the Fed did not pivot. The Fed is not easing the monetary policy. So to me, that appears to be a false bottom. It appears to me that this is another bear market rally. But unlike other bear market rallies, this one has two elements that we have not seen so far this year. Element number one, the euphoria, which is exactly what we saw back in August of 2020. Element number two is the arrogance. And this is exactly what we saw in the meme stock mania in early 2021 and the so-called Santa rally in 2021. We all know how both cases ended. So my strategy right now is, instead of chasing the mania, I'm becoming the Johnny-come-lately who's going to hold the bag. What I'm doing, I'm not saying what you should do. You can do whatever you want to do. It doesn't matter to me. It's your money. But to me, what I'm seeing right now, let the FOMO crowd jump in. Let this process, the so-called June bottom all the way to here, a process of collecting money. Fresh, new money coming into the market. I let them do that for me. And once they're all in, as the famous scene from the Bronx Tale, now you can't get out. You're locked in. I place a short. And now all of that money from the FOMO rally ends up being in my pocket and the pockets of others who shorted the mania. It is a transfer of money when you think about it, from one hand to the other, from the FOMO crowd to the ones waiting to hunt. Bear markets are a process of transferring wealth from one hand to the other. From the hand that says, this is it, this is the bottom, higher we go, to the hand that says, not so fast. We've seen this movie before. Bottoms don't happen this way. This is yet another bear market rally that will frizzle out. When I see the VIX at 20, for example, everybody's chasing the mania right now. Not me. Right now, I'm building put options positions across the market. We discussed certain overbought charts in yesterday's video. These charts became even more overbought today. So while the VIX is down, puts are cheap, it is an opportunity to bet against the former rally, number one, but it is also an opportunity to hedge my portfolio. And this is how I see it, folks. We've seen the movie before. It's no different. Until the Fed legitimately pivots, the bottom will not happen. Anyhow, let's move on to cover the stock market information for you. And I start with the closing of the indices today. And here we go. The Dow Industrial Average in the green by 535.10 points, or a gain of 1.63%. The Nasdaq up by 360.88 points, or a gain of 2.89%. The S&P 500 also in the green by 87.77 points, or a gain of 2.13%. The sectors' performances all in the green. We're not going to shame anybody today, but at number one, capturing the gold medal, technology. Number two for the silver. Cyclicals, number three for the bronze, communication services. The advance to decline ratios, NYSE 83% advancing versus 13% declining. The Nasdaq 75% advancing versus 19% declining. The breadth was pretty good. We got the algorithmic lift, that tide that lifted all boats. No exceptions at all. Commodities, what's going on here? A sea of green. So again, if you say, hey, peak inflation, energy commodities are going down, stocks should go higher. Commodities say not so fast. If the dollar goes down, commodities will go higher again. That's how it works. We have energy commodities lining up in the green. Modest gains for crude, about 1% apiece for the WTI and Brent, but we have sizable gains for the RBOB, gasoline, above 3 once again, with gains of about 3.25%. And then we have heating oil scoring about 2% worth of gains today. And the party boy, natural gas, adding more to the gains with about 5% in the upside today. Softs, what's going on here? Green across the board, cocoa, cotton, OJ, coffee, lumber, sugar, all in the green, with decent gains here. Lumber is up by almost 9% today alone. OJ back in the green, scoring gains of over 2.25%. Coffee, I hope you read the CPI, and if you did, you now know that the inflation in coffee prices is absolutely insane, and it's not stopping anytime soon. Coffee futures closed the day with gains of about 1.5%. Metals, green across the board with one peculiar exception, that is gold. Silver in the green, platinum, copper, palladium, all scoring gains, with exception of gold. Is gold saying something here? Don't trust the move in the dollar? This is exactly how I'm seeing it. Meats, green across the board, no exceptions here. Gains of about 1% apiece for live cattle, feeder cattle, and lean hogs futures. When it comes to grains, we have a pullback in oats futures, down by about 3%. Likewise, soybeans and canola futures were muted and traded down slightly, while rough rice and soybean meal were pretty much flat, be it in the green. Yet the gainers, led by wheat futures, scoring gains of about 3%, followed by soybean oil and corn futures. Moving on to the big casino, the options market, what's going on here? No improvement in volume, but we're seeing improvement in the put-to-call ratio. Not by a lot, but it is notable. We went from betting on buying more puts on names like Tesla and Apple to buying more calls. But here it is at number one, the hottest table by far, Tesla, at around 1.4 million contracts traded today. About 59% of those were calls. And at number two, Apple, at around 1.3 million contracts traded today. About 52% of those were calls. And at number three, Amazon, with around 800,000 contracts traded today. About 52.5% of those were calls. Moving on to the unusual activities that took place in the options market today. We start with the ticker ARKKKKK for Tesla witch Cathie Wood. Somebody's making a massive bet here against Mama Cathie. They bought the 48 puts for the expiration date, October 21st, with expectations that the RKK could go down by more than 7% by then. They paid around $3.30 a piece to enter this trade, all in all spending around $22 million. And then we have a bet for the SPY. Somebody's buying calls, betting that we have more gains to come in the SPY. They bought the 445 calls for the expiration date, August 31, with expectations that the SPY will move higher and gain over 6% by then. They paid around 40 cents a piece to enter this trade, all in all spending around $1.6 million. On the other hand, we have somebody fading the rip in the Nasdaq this time around on the triple Qs. They bought the 308 puts for the expiration date, August 22nd, with expectations that the Qs will go down by more than 5.5% by then. They paid around $1 a piece to enter this trade, all in all spending around $1.5 million. And then what about the ticker CLAR? This is for a company called Claris, It's an outdoors company. They make equipments for outdoor activities, but the name is heavily shorted. And if we look at the chart, as you can see, we have a sloping line of resistance that goes all the way back before the year even started. And then we have the saucer bottoming formation, and the chart broke above the sloping line of resistance. It is now facing some resistance at around, let's say, 23.5. But if it passes that, then there is more juice in the short squeeze. In this case, somebody bought the 25 calls for the expiration date, October 21st, with expectations that the name could move higher and gain more than 7% by then. They paid around $2 a piece to enter this trade, all in all spending around $1.5 million. And what about the ticker META, Meta? Also known as Facebook. Somebody sees more gains to come. They bought the 200 calls for the expiration date, September 2nd, with expectations that Meta could move higher and gain more than 12% by then. They paid around $1.45 a piece to enter this trade, all in all spending around $1 million. And lastly, what about the ticker RBLX, Roblox? I had puts in the morning, but when I saw the mania going on, I had to close those. I had modest gains, not the same gains that I was anticipating, but then by the end of the day, I followed this trade exactly. So I upped my strike price from 40 to 43, and I see this as a better deal now. And the trade is buying the 43 puts for the expiration date, August 19th, with expectations that Roblox will move down and lose more than 10.5% of its value by then. And we paid around 85 cents a piece to enter this trade, all in all spending around $550,000. Moving on to the heat map analysis, what's going on here? A sea of green, no exceptions, very few. In healthcare, JD, that was down. But besides that, we have the algorithmic tide that lifted all boats. But the underperformance is notable. Energy, utilities, REITs, big pharma, the consumer staples, all in the green but muted. So the majority of the money chased the cyclicals, technology, software, chips, communication services, the risk-on kind of stocks. Is that going to last or not? When we see action like this, you know that this is not sustainable. The market is going to comb through these gains and decide which sectors are going to be the ultimate winners. For example, we're not going to see materials and industrials, for example, rallying hand in hand when we see technology and software moving higher. The market is either going to settle with the technology risk-on trade or the value/inflationary trade, which also includes the defensives and utilities and REITs and the consumer staples. We got the knee-jerk reaction. What about the aftermath, the digestion? When we look at the month-to-date, this is for August versus the year-to-date gains for the different sectors of the stock market. And by the way, this is from Miss Lizanne Saunders from Charles Schwab. As you can see, energy, the year-to-date winner, is actually down for the month by about 4%. Likewise, utilities, the second winner for the year, is lagging with about 2% gains month-to-date. The leaders of the gains month-to-date, and frankly, since July, we're talking about the losers year-to-date. Communication services, consumer discretionary, information technology, all of these are the losers year to date, and they're seeing a rebound. When you look at that, you have to be a little bit skeptical, because what if this is a short covering rally? What if this is a bear market rally, taking the losers for the year and we see them catching a bid? But if the assumption is that we have a soft landing and a recession is avertible and everybody's getting jobs, then this should be good for energy. Energy should be joining the rally, but this is not what we're seeing, at least so far. And then we have the heat map for the ETFs. What do we see here? Obviously, growth is outperforming value, be it both in the green. Pretty much every single ETF in the green, with exception of the inverse indices, the VIX proxies, but besides that, everything in the green. We have laggards. The laggards are the defensives and utilities, the XLU in consumer staples, the XLP, in the healthcare, big pharma, the XLV, all in the green. But they're lagging the chips, for example, the SO, XL, the SMH, massive gains there. When we talk about internationals, all in the green with exception of Chinese ETFs, the FXI, MCHI, all lagging today. When we talk about commodities, gold is muted, but natural gas moving higher again, the UNG, oil, all moving higher big time. And folks, we have many catalysts and many tailwinds for natural gas to pop higher in the fourth quarter. So what I'm saying is, what if these energy commodities rebound? They don't have to go all the way back to all-time highs. All what they have to do is just rebound by a little bit, and the so-called peak inflation/pivot theory is done. So for now on, the market is going to pay close attention to the futures, crude oil futures and natural gas futures. If they continue to pop higher, impulsively so, this rally is going to frizzle out, because the assumption that the Fed is bluffing, that will go out of the window when energy commodities make a comeback, because nothing in the core CPI suggests that we have a sustainable decline in inflation month over month. Moving on to charts, and we start with SPY, S&P 500, 30 minutes chart. What's going on here? The technicals don't matter at all when you have a massive fundamental catalyst that could trigger algos. And therefore, we got a massive gap higher above 416, now consolidating in a bull flag pattern. But is it going to play out? If we have a trap, if you believe this is a trap, what will happen is the digestion will happen, maybe due to new data such as the PPI or otherwise. But you will see the experts coming out and saying, oh, the rally went way ahead of itself. Turns out the CPI is not really a peak CPI reading. Turns out the Fed is not pivoting. These are the same people who, for the last 2 weeks, been pumping and saying the Fed is going to pivot. We have peak inflation and the soft landing is a real possibility, yada, yada, yada. But for now, there is no technical reason for the chart to go down. After a pop like this, the bulls would argue, we've seen this before. The massive gap higher, consolidation, and then a resumption of the rally. So higher we go. Even though last time around, the RSI was overextended. That did not matter. We got a rally either way. And this is a similar look, so we'll have a similar outcome. In other words, the bulls are placing their bets on the technicals. The bears, on the other hand, are placing their bets based on the psychology and the fundamentals. But nothing technical here suggests that we have a reversal of any kind. And here is the daily chart for the continuous contract for the S&P 500. It is getting closer and closer to the end of the range at around 4,200. The volume was slightly higher, but we're not seeing the institutional type kind of volume, the massive spike higher, the conviction that this is indeed a beginning of something new, that the Fed is indeed pivoting and we're going to go back to all-time highs. We're not seeing that type of conviction yet. We also have the momentum indicators, which continue to be in positive territory, but the problem is they're getting way overextended. So the risk versus reward is against the Johnny-come-latelys chasing this rally. And it is in the favor of bears who are waiting and waiting to start hunting. And by the way, 4,200 will be stiff resistance. It's not going to be easy to crack above. It's going to take time, consolidation, institutional participation, lots of call options buying. A lot of things have to happen for the chart to crack above 4,200. What about the Qs? 30 minutes chart. What's going on here? Another pop higher, massive, big time. And it got us all the way to the top of the range of the week. So this is the top of the candle on Monday at around 326. And we stopped right there and then. So is this it? We're just going to retrace the top for Monday and then move down? There is no technical indicator that says we should go down right now. But there is a psychological indicator, which is the digestion of the knee-jerk reaction that we got today. And these charts are not going to matter, by the way. What's going to matter is the dollar and the 10-year yield. But here it is, the daily chart for the continuous contract for the NASDAQ. It popped above 13,300. This is the good news for the bulls. The volume remains below average. And the next destination would be resistance number 1 at around 13,600. And resistance number 2, that would be the most stiff one at around the trend line in yellow. Depending on when the chart gets there, this could coincide with around 14,000. It's a long shot, but it could happen. Some signs for concern here. When we look at the RSI, for example, we have slight negative divergence. That could play out, but the chart needs to lose more support lines for the bears to have the confirmation that they should start shorting aggressively. And losing 13,300 as support, that's not enough. We need to see 12,766 be lost as support. Then we're talking. And another thing we have to watch is the psychology, because right now, looking at the chart, the bulls have the all clear, at least on face value. We got the Fed conference out of the way. We got the jobs number out of the way. We got the CPI out of the way. We got earnings out of the way. All the bad news out of the way right now. The sky's clear. The NASDAQ has no excuse to pull back at all. So any weakness from this point on will be really suspicious. Why are the bulls not betting on more upside? Why are they stalling right now? Why are they taking profits right now? The psychology will be really important, but the confirmation will be technical in nature by losing important support lines. What about the IWM, the Russell 2000, 30 minutes chart? What's going on here? We got the gap higher, the Russell outperforming the SPY and the Qs, and it has been doing that for a while now. The problem is it is getting really overextended. Now, my target is 196.5. Here's the problem. I did not wait. I already shorted. By the end of the day, if it gets to 196.5, I'll add more, but I think we're getting close. We're getting really close. If you have the expiration date in September, October, you're not going to have a problem. If you have the expiration date of next Friday, you're going to have a problem. But for now, the odds, the risk versus reward says the IWM should go down in a retest of 191.5, if not closing the gap. The Dixie, the dollar index, what's going on today? A massive drop, but I'm not buying it. I think Tricky is about to surprise you here. Tricky Dixie. We don't call it that for no reason, by the way. It is playing possum right now, giving everybody the false sense of security before it pops higher again. You'll see, you'll watch, you'll come back. And here's gold. By the way, the telltale that the Dixie is faking it, because look at this, gold had every reason to explode higher today, but it did not. As if gold is saying, wait a minute here, I don't care about the party, I'm not trusting the dollar. And you will find out that the market has the ability of ignoring the Fed speakers coming out every single day saying we're not done, we're going to raise interest rates over and over and over and over again. But there is a limit to that. There is a point where the market is going to break. Is it going to be by daily tomorrow? Is it going to be by Bullard some other day? Is it going to be by Boystick? Who knows? But one of these speakers is going to say, we're not done here. We're going to go 4% plus. This CPI is concerning. Yada yada. Who cares? Whatever reason they give. Then the market all of a sudden will listen. This is how the market reacts. Amidst the former rally, it's shake it off. I don't hear anything at all. But as the former rally starts to materialize, guess what happens? Those who bought way before, a couple of weeks ago, 3 weeks ago, in June, in May, they're going to start to take profits because they made a ton of profits and they start to listen and they initiate the sell-off. You see, the rebound happens by shorts. The shorts who made the most profits, shorting since the top, they start listening and they say, okay, maybe the Fed is going to give some false signal or maybe a hint that they're going to start easing. And before they do that, these shorts start to cover. And they initiate this massive rebound that we got. Those who bought that rebound early on are the ones who are going to initiate the sell-off by pulling the trigger. And gold right now is saying, I don't trust the dollar. I think the dollar is faking it, and therefore I'm not popping higher. I'm staying put until I see further clarity. What about Brent? 4 hours chart for crude. It retested the support of 94.5 over and over and over and over again, and decided to pop higher today. If that sentiment continues, we will see crude above 99, and then after it does that, the short covering starts to kick in, and before you know it, crude is back above 100, 105, 110 once again. And all of that pivot theory, peak inflation, CPI is done, that will go out of the window so fast, you're not going to even believe it. This chart is really, really important to watch. A crack above 99 will initiate a short covering rally. And here is the weekly chart for Brent. It is holding at the most important Fibonacci support. If that support is broken, more selling will happen. But if it rebounds from this point on, short covering will happen instead. I shared with you multiple charts before indicating that perhaps oil is due for a rally. Oil is due for short covering. This will be a problem for the stock market. And here it is, the 10-year yield initially. After the CPI, it went down big, but it rebounded higher and closed pretty much at the highs of the day. We'll look at the MACD, the hour side, they're all firming up, indicating that higher yields are coming, in the 10-year at least. And by the way, the 2-year yield, which is more important to watch than the 10, also rebounded higher. Not all the way, but off the lows, indicating that the Fed is not pivoting. But somehow the stock market believes that the Fed is pivoting. Here's the TLT weekly chart. It is moving down. You would think that we have a cooler than expectations reading in the CPI. This should be good for the TLT. We should see a short covering rally in the TLT because the Fed is not going to increase interest rates any further from here. But the TLT is saying, no, I don't see it. I don't think the Fed is pivoting. Next, the VIX 4 hours chart. What's going on here? It got below 20 despite my hunch that it's going to rebound before 20, but it cracked below 20. We'll look at the MACD indicator. We now have negative momentum. Not confirmed yet, but we are in negative momentum. The assumption for now is we have weakness in the VIX that allows the SPY to move higher, but every time the VIX goes to 20, at least so far this year, it has been an opportunity to load up on puts and take profits from the longs. And the VIX rebounds sooner or later in or around 20. Is it going to be different this time around? And how low can the VIX go? If we had the action that we got today and the VIX was at around 28, 30, I would have said yes, there is more juice to come in the SPY and the Qs. But when the VIX is at around 20, the premiums on puts are really cheap. Nobody wants puts anymore. The seasonality, we have the summer rally, August, volume is down, etc., etc. I see that as an opportunity to accumulate puts at a cheaper price now. Whether I'm betting against stocks or whether I'm hedging my portfolio. The VXN 4 hours chart, it broke below the most important support at around 27.5. And this should support more gains in the Qs, but I don't see the conviction yet. When I look at the MACD, the momentum indicator, I'm not seeing the conviction yet. I'm seeing both the RSI and the MACD being actually suppressed. And if the bears believe that this is a trap, what we got today, then what you're seeing right now in the VXN supports the trap. It looks that the VXN is done. It lost an important support. It should go down all the way to 21, and that should enable the Qs to move higher. But what if this is a trap? If it is, the VXN pops higher, above 27.5, while the Nasdaq starts to pull back by tomorrow. Otherwise, the VXN is not pulling a trap. What about Apple, a daily chart? What's going on here? Got a nice pop, a gap higher, but it is getting way overextended in the RSI and the MACD. You combine that with the fact that the VIX is at around 20, the puts are really, really cheap. I'm waiting for a reversal signal. Right now, I don't see any at all. I need to see a reversal signal that erases at least 1 day worth of activities. And that would be batch number 2, and then batch number 3 happens when the chart gets closer to 160. What about Tesla, the souffle, 30 minutes chart? What's going on here? Not looking good. Despite the pop, not looking good as Apple or the Nasdaq or the SPY or the IWM. It kind of underperformed Tesla. It did not close at the highs like other charts. What does that say? I think a lot of folks are now realizing that Elon Musk is a snake. He said he's not going to sell any more shares. He's done. But every time the stock pops higher, he's going to see it as an opportunity to dump more. It's easy money. He can dump billions of dollars instantly. It's almost stupid not to do it. So there is a ceiling in the stock. Despite what Elon says that he's done with the selling, he's going to do it again. And you're going to see a lot of shareholders now saying, you know what, maybe it's a good idea to book some profits here. Elon is doing it. Why not me? And the chart moves down. It is now facing the resistance at around 886, and it is forming what it appears to be, at least for now, a bear flag pattern. You can look at it as an ABC pattern. Doesn't matter. What matters is if it doesn't crack above 886 by tomorrow, the likelihood is it's going to crack below 866 and form the C leg, the bear flag play out, whatever we want to call it. Doesn't matter to me. And it closes the gap below. And the problem with this chart really is the monthly chart. Again, negative divergence in the RSI, the head and shoulder formation playing out. If I'm Elon, this is the last chance to raise billions and billions of dollars the easy way. Next, Bitcoin, 2 hours chart. What's going on here? I'm not believing anything that's going on with this chart right now. It is pulling trap after trap after trap. It built the bull flag pattern, indicating to everybody that higher we go, which means risk on, only to melt down and go back to the consolidation zone. And today, it is popping higher, forming another bull flag pattern. We have some resistance at around 24,250. But what if Bitcoin serves another pie in the face and moves down tomorrow, back in the consolidation zone? That would be really bad because we're going to have a double top formation, a double rejection, and that will confirm the break below the consolidation zone. But if it breaks above the important resistance at around 24,250, then this time it's the real deal. The bull flag is going to play out, and we talked about the weekly chart of Bitcoin. The target is, if we have a bullish breakout, 29,000. But the target below, if the opposite scenario happens, is 22,000. Now let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the initial jobless claims for the week, and we have the PPI, the Producer Price Index. Will this confirm or negate the CPI that we got today? And then we have another Fed zombie speaking, used to be Dove, San Francisco Fed President Mary Daly. Is she going to come out and say the same thing that Kashkari and Evans said today, that they're not pivoting? I feel that they're getting the same instructions, all of them. So I have no reason to believe that Daly is going to come out and say, oh yeah, that CPI reading that we got yesterday, that's peak inflation, and we should not do 75, we should do 25 or even cut rates. I doubt it. We have interesting trading days ahead, but for now, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
I'm the hand of Mona Lisa's skirt. I'm a surprise, Kevin. They don't see me coming. That's what you're missing.